All right, without even knowing the details, the market like this trade deal that we have apparently with Mexico, only Mexico for right now, Canada we're told down the road, but that tells you something about the market's thinking right now. Better to remove the uncertainty of an escalating trade war than to get the certain details about the deal we have to avoid that trade war. Anyway, the former budget director for Ronald Reagan, David Stockman, on what all of this means. Markets like this, what do you think?
I think it's a great big PR stunt. Mexican workers are going to get a raise to $16 an hour. Big trade nanny in Washington is going to spend countless hours of lobbyist time and consultants' time trying to figure out whether exactly 45% of the content of a 5,000-pound car with 30,000 parts was made in Mexico or the United States, and whether or at over $16 an hour, and whether 75% was made in Mexico or the United States.
And that's the idea behind this, right? That we want more North American control.
Yeah, but this isn't going to be, this isn't MAGA, okay? This isn't going to do a lot for the American economy or workers. In fact, NAFTA was never a problem. The whole thing is like a phony issue. Now, the big problem with Trump is he's got a deficit totally out of control, 10 years into a recovery, slamming up against a Fed.
So you're not talking the trade deficit, you're talking the budget deficit.
I'm talking about the budget deficit, slamming up against the Fed that is finally deciding it's got to have real interest rates and going to shrink this enormous balance sheet.
What did you think of him jawboning the Federal Reserve?
Terrible. They're doing the right thing. He's a low interest man. How can you have negative interest rates in real terms, that's below zero, for 10 years running? That's what we've had. It's just fuel for this massive speculation in Wall Street. This is the greatest fake bull in history. And
well,
now,
it's making a lot of people rich. The president argues you go after him, and let's say after you push these investigations going, talk impeachment, the market will implode. What do you think of that?
Well, I think that's right, but I think it's going to implode anyway. We're heading for the biggest bloodbath in politics during the next 2 years that you've ever seen. Most of Washington wants to run the guy out of town. That's what, and this thing is getting worse. They're going to win.
But with him in town, they've been making money hand over fist. Most American investors, right?
Well, the speculators have been making money hand over fist. If you want to stay in a market at these extreme peak levels, but
average Americans, you could say it's starting to speculate, but in their funds and 401k, they're looking at it and saying, hey, I don't care who's doing it. I like it.
Well, that's what they said in the year 2000, and in the next 3 years,
but to be fair, David, you've been saying this for some time. What's going to be the magic point?
Neil, these cycles only last 7, 8, or 9 years. They're not based on fundamentals, real economic prosperity, growth, free market, efficiency and production. This is Fed-fueled, central bank-fueled, and they're at the end of the road.
Well, then are you surprised this Fed-fuel rally continues even with the Fed raising rates?
No, I'm not surprised, because they're just beginning to do what's going to crunch, and that is drain cash out of Wall Street as they
But it's not happening.
It's beginning to happen.
When? Tell me exactly when so I can get out.
Okay. I don't know exactly when the peak is going to be achieved, but when you have a Fed that's going to be draining the bond market by $600 billion a year, and you have a Treasury trying to borrow $1.2 trillion or more, you're asking for a collision that is going to rock the whole system. This isn't stable. This is pure speculation. This is the chart monkeys trying to peg or tag, as they did today, 26,000 on the Dow, 8,000 on the Nasdaq.
But even at these levels, I'm telling, and I know technicians can be all over the map, but even based on trailing earnings, this is not an extremely rich market right now, and given the lower taxes, cheaper still. In other words, it's nothing like the boom that you alluded to.
No, they're absolutely like the boom I referred to. The market today at 2,800, 2,900 is trading at.
You're talking about the S&P 500.
It's S&P 500 is trading at 25 times trailing earnings when you adjust for the one-time tax increase. Okay.
Well, but we have to keep numbers to numbers. You could say it's around 18 right now. It's a little above the historical average, right?
No, it isn't. It's really 25 based.
You can't X out a tax impact.
Okay, it's 24 even without the tax.
No, that's just wrong.
No, it isn't, because the earnings for the trailing 12 months through June 30th are $123 S&P share. That's the number.
All right, so you're all right. We got to argue this, but you're saying it's still a rich market. We got to be careful. What will happen? What would be the trigger event?
It's hard to say, but I think the Democrats winning the House, which looks increasingly likely, would be one. You'll have 21 standing select committees holding investigations on everything related to Trump from now until the 20...
You could argue that just keeps everything locked in place, right?
No, it doesn't, because you have a fiscal situation that's exploding. How are they going to make agreements to raise the debt ceiling? They're going to have to borrow $3 trillion more between now and the next presidential election.
They always find a way. Now, I don't like the way they find, and you and I talk about this, and Republicans and Democrats have done that, but they always find a wacky way.
Look, you can't...
You argue we're running out of, like, magic tricks,
We're running out
right?
of runway. We're running out of rationality. You can't be borrowing this much money when central banks of the world have made an epical pivot to QT, to tightening, to finally shrinking their balance sheets after 20 years of just egregious expansion. You can't just think that none of this will have an impact.
Where is the most profound bubble to you?
I think the most profound bubble right now is the NASDAQ at 8,000, okay? Remember, people said last time in the year 2000 when the NASDAQ 100 was at 47, I remember it well, March 27, 2000. Don't worry, we're 13% above the 50-day moving averages. All the charts are great. 13 days later, it was down to 3,200.
No, you're quite right, but that was also a rally built on a lot of companies that didn't have earnings and all. You can make the argument now that a lot more of these technology names that dominate the NASDAQ have a much better financial footing than their counterparts did the last bull market.
Oh, I don't know. The Russell 2000 set a record today. You know, a third of the Russell companies don't have any earnings.
What are you invested in?
I'm saying staying out of the bond market, stay out of the stock market. Keep your powder dry, build up cash.
But what's your powder dry? I mean, are you putting all your money under a mattress?
You can put it in 2-year treasuries, 1-year treasuries, 90-day bills. They're paying 2 or 3%.
But you wouldn't go out much further than that.
You wouldn't, because this is a hothouse market. This is not...
Well, whose fault is it? You're not blaming just President Trump. You're blaming everybody.
I'm blaming what we've been doing. But let's just look. This market is up 75% since the... I'm not talking about the bottom, the peak before the crisis, mid-2007, okay? 75%. Take the inflation out, 55%. Real gain in the S&P 500. Now, let's compare that to median real family income, up 1% in 11 years. Let's compare that to industrial production. 11 years, 3%. Not a year, 3% total for 11 years. Let's compare it to the amount of labor being used in the American economy. Hours, you know, real physical hours, up 5%.
So these upticks that you've seen in all of the above, albeit slow and late, are not encouraging it.
No, because they're only slight upticks from a dip we had in 2016 and 2017 when we had a kind of mini recession in the world because of commodity prices collapsing and trade and industrial production. And now we have a world looking at China, which is a house of cards, Europe, which is now sputtering again, the United States, 10 years into a recovery, 9 months from the longest one in history.
We're the leader of the world.
Now, this is crazy. This is utterly crazy.
All right, I'll put you down as maybe iffy on how this thing is all going. David Stockman, always a pleasure. I always like you to hear all points of view on this sort of thing. Whether you're a bull, you're a bear, you have to hear each argument.